From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, January 28th. You're listening to the Macrocast. This is Tony Fratto from Hamilton Place Strategies. We have Brendan Walsh and John Fagan from Markets Policy Partners with us, and John Dick come to us from the hills of South Central Pennsylvania, where he's holed up for the not for the winter, but at least for a good weekend, but still able to keep track of what's going on in the world. Our friend from Civic Science, John, it's great to have you with us. John and Brendan, we're going to be back talking about inflation again. It's going to be a theme. We got data this morning on PCE. When you guys want to just take us through the numbers right now, they just printed about an hour ago.
The core PCE prices are that's the Fed's preferred inflation metric. It came in essentially as expected this morning, 0.5% on the month-on-month pace, which matched last month. This is for December, so that matched November. The headline was a little bit higher than expected, 5.9%, which is again like one of these eye-catching, like highest since 1983 kind of levels. But because it didn't feature an upside surprise. And it is a backward-looking number to some extent. It's actually been received pretty well in financial markets. We saw the equities pop a little bit on the number, and we've seen Treasury markets actually 10-year Treasury yields come a little bit downward after that release. The Fed has characterized inflation as sort of a monolithic risk at this point. They've pivoted very forcefully toward tightening and inflation fighting. We saw that posture really cemented and almost redoubled at the meeting at the conclusion of their 2-day January meeting on Wednesday of this week, where Chair Powell, despite being relatively balanced, whenever he talked about the risks, it was always toward, upside of inflation. It was always tilted toward having to tighten more. Now, there wasn't a lot of airtime given to, downside risks if inflation moderates, if growth starts to slide. It was relatively, it was quite skewed in a hawkish direction. That was, to a greater or lesser extent that was expected, but we still saw futures markets price in essentially an additional rate hike going into the meeting. There were 4 full rate hikes, 25 basis point rate hikes priced in for this year, and coming on the other side of the meeting, there were 5, and that kind of tells you all you need to know. We saw the Treasury yield curve flatten out very dramatically after that communication from the Fed. We saw the dollar spike, and equity volatility continues to be elevated. The data this morning, because it was, as I said, in line with expectations, it didn't feed the narrative of inflation getting worse, and that's a good thing. Brendan and I expect inflation to actually moderate, over the coming months, despite supply chain factors being pretty acute here with Omicron over the first quarter. But we think the Fed is probably not going to have to do as much as they maybe think they are at this point.
Something that exceeded expectations. So while you're right, the inflation numbers this morning nailed expectations for the most part. What exceeded expectations was GDP growth for Q4, that showed the economy running a lot faster than expected. Some of that was these numbers came yesterday with some inventory rebuilding and maybe some. Again, nominal growth running pretty fast. Some of it, supported by price increases. Also, was there anything in the GDP numbers that surprised you besides just the overall pace?
It was really the pace looked great, but as you said, it was that inventory build, which isn't necessarily something that you want to count on for the coming quarters.
And we do quarter on quarter analyze, so you can get. Something like inventories can have an outsized effect on the quarterly numbers, which I think that kind of happened there in the fourth quarter.
Yeah, and so it was a little bit more nuanced, and we've seen some kind of muddy retail sales numbers this morning. The December personal income and personal spending figures looked a little bit lighter versus expectations. And this, the little hiccups that we've seen in U.S. data, I think are inducing a higher level of growth uncertainty because, maybe because market signals are also pointing in that direction. But Europe's growth, Germany had a recessionary number in the fourth quarter. They had a contraction of GDP. We've seen some downbeat business sentiment, economic sentiment readings out of the EU, and concern that maybe that is coming soon to a theater near you in the United States.
In terms of sentiment, John Dick, inflation just seems to be dominating everything, doesn't it? I mean, because we have the strong GDP growth, we have strong job growth. COVID is out there, so maybe it's inflation and COVID, even though that's largely tailing off. I mean, the ESI numbers showed some continuing weakening from consumers. What are you seeing?
Yeah, I mean, well, first, so the last reading was down for the ESI, sort of post-holiday. It had been up for a couple readings in a row through Christmas, and that was sort of like a Christmas cheer factor. I think I think people were just being extra resilient with their spending. Holiday in aggregate will turn out to be really strong, but mostly because so many people shopped much earlier. So we saw really strong, even like pre-Black Friday, and then we saw a surprising lull after Thanksgiving, and then a little pickup in the last minute holiday shopping. But yeah, I mean, inflation is of course driving sentiment because people see prices going up, and when we ask them how they feel about the economy and their outlook for it, it has a kind of a sobering impact on it. One of the other reasons, and you touched on it, that the holiday was going to be strong wasn't because units were up, but just simply because prices were up and people just spent more money on things. And going into the new year, John Fagan, you used the word monolithic, which I thought was interesting because the consumer landscape is anything but monolithic. We are actually seeing a very clear bifurcation between higher income and lower income households right now, and their views about not just their views about the economy, but their spending. Rich people got richer through the pandemic. There's still $1 trillion of spent up savings that, I think Moody's suggested was going to deplete at about $50 billion a month, but that's a long time to stretch that out. But that money is in the hands of people who worked remote, kept their jobs, rode money in the stock market, didn't spend in huge categories like vacations and other kinds of things. Then you've got the other end of the spectrum of people who aren't in that category. They're feeling the pinch at the grocery store, man. They're already telling us they're cutting back and spending on meats and cutting back on fresh produce, which has all kinds of public health implications too. But yeah, it's a very bifurcated story right now. I mean, concern about inflation as people, when they're asked about it, is pretty universal, but the actual impact of it right now is not even in any way.
Yeah, it'll be really interesting to see if the richer households begin to show up with a little less confidence because, as you say, they've been riding that stock market higher, and a lot of the stocks that they've ridden higher are now, 50% off.
Quite a bit, yeah.
Well, it's interesting you say that because on Monday when in Monday morning when looked like the wheels were falling off and we had things sort of bounced back a bit. We measure this stuff in real time, right? So we're gauging sort of economic outlook in those hours of the morning and it had zero impact on people in terms of their overall perception of the economy. I think a lot of us pay much closer attention to the undulations of the stock market than the average bear does. Now, if we had a sustained drop, I mean that might be different. But Brendan, you mentioned something about tax bills coming up, potentially student loan payments resurfacing. That got delayed a bit, so that was a bit of a lifeline for a lot of people. But we also saw a heightened level of credit card spending over Christmas. So yeah, people again were very resilient through the holidays, but they weren't. They were borrowing more or less to cover their Christmas bills, and those credit card bills are going to show up in January too. Yeah.
One of my friends is a mortgage broker, and he's seeing a huge amount of people that are willing to refinance out of pretty low levels like 2.8, 2.9 to 4.5 because they want that money, and a lot of it is for debt consolidation.
Yeah.
Interesting, because balance sheets, I mean, look, at least the data that I'm seeing on balance sheets and household balance sheets, most of the debt measures and balances in bank accounts remain pretty healthy. We saw, I think it was almost 10%, faster growth in consumer spending in the fourth quarter also came out of the GDP numbers. Am I reading that right, John Fagan? It was so on the order of 9 or 10% year over year, stronger consumer spending, I think. At any rate, the consumer was very powerful in the fourth quarter overall, and balance sheets, household balance sheets, still seem to be in pretty good shape. But that is not that doesn't go on forever. Even as we see wage increases and we see employment up, wage increases are not. I take John Dick's point about the sort of asymmetric paces of growth in various sectors of the economy, but wage increases are not quite keeping pace with inflation. So to John Dick's point, in some parts of the economy it's worse. Some parts of the economy it's probably just fine. Where the wage increases are keeping households strong enough.
Yeah, I mean, exactly. I think that fourth quarter, yes, on balance was strong, spending was strong, savings was strong, but it masks that, like you said, asymmetry and also, I mean, just January is a completely different bird from December, when the Christmas drives a lot of spending behavior, sometimes irrationally. One thing that is a bit of a positive note is general perceptions and concerns about fuel prices has fallen. And, that couldn't have come at a better time with it getting so cold above the Mason-Dixon line and home heating bills and things, so that was a little bit of a silver lining on things that might help get us through the next couple months. But
yeah. Two things that I always watch are Visa and MasterCard earnings, because they're kind of a perfect indicator of economic growth. They just process debit and credit card transactions. And especially Visa really beat handily, but more importantly, their guidance was
very strong,
very optimistic. And a lot of the beat was on cross-border transactions. And what they're kind of seeing is that the pandemic is coming to an end, and they kind of expect a return to normalcy here pretty soon, and are quite optimistic about 2022.
Why don't we? I think that's a pretty good review of where things are with the economy. We touched on the Fed a little bit and what Powell had to say. Why don't we come back after the break and dive a little bit deeper into what we think the Fed's going to do and why, and what the consequences of that are going to be. You're listening to the Macrocast.
HPS is hiring full-time public affairs associates and analysts. We're seeking entry-level associates and analysts to join our dynamic team. Associates have immediate client exposure and opportunities for professional development while working in a fun, fast-paced, and challenging environment. Recent graduates or applicants with up to 3 years of postgraduate work experience are encouraged to apply. Learn more and apply today at hamiltonplacestrategies.com/careers.
Okay, we're back on the Macrocast. John Fagan, just dive in a little bit, deeper into the FOMC. It was a pretty interesting, it was a pivot, right? But it was less, to me, less dramatic than I think the market initially reacted to. And as you correctly point out, the expectations, adding an expectation for a fifth raise, which is pretty significant, much farther from where your prediction was, right? I mean, you were at 1 and I was at 2, right? And
I'm still taking 5. The under.
Yeah. So we can't say that we were buying it, but I think he made it pretty clear where he's going. At the same time, he kind of signaled it back in December. But your point on the how he's talked about these things, every time sort of leaning into a more hawkish view, I think was the thing that observers, gleaned from his presser.
That's exactly right. When you have the markets, at the beginning of the pivot, there was a sense that, well, the Fed has now turned hawkish and pivoted toward inflation fighting, but they're not going to get much more aggressive than this. And they've ratcheted it tighter. Absolutely. Like every meeting, every month, every opportunity they've had to communicate, it's been a little bit tighter than the last time. And this was in that general trend as well. He was expected to signal March, and but at the same, but he didn't rule out hiking at every meeting through the year. He, was obviously very cagey about balance sheet basically balance sheet shrinking, taking what they call quantitative tightening versus quantitative easing when they put that asset purchase program in reverse. He was obviously cagey about the time, but at the same time, he characterized the balance sheet as, much bigger than we expected. It's going to have to shrink a lot. That kind of verbiage was incrementally more hawkish than the last time they talked about balance sheet. It's there is a sense that the Fed is operating here with the zeal of the converted. Maybe to some extent they're playing toward expectations, and they're trying to get as much kind of tightening priced in now because the pricing in of tightening has a tightening effect. But at the same time, Fed Chair Powell was very clear. He said, tightening financial conditions are still very loose. That was a communication that the ructions in the stock market are not about to knock the Fed off their line at this point. And this is when, the S&P 500 is flirting with a correction. The NASDAQ is in one. These are, pretty chunky downside moves in the stock market. And the Fed has said, full speed ahead. And asked about the yield curve. He batted that away as well. Growth risks really didn't come into the discussion much at all, except with relation to how high inflation can impact growth in the labor market. Exactly. And so
he's quite straightforward in his answers, kind of the opposite of Greenspan. And a lot of the questions were to risks, and he just kind of answered them bluntly. And I think that came through to the market that he really never addressed downside surprises, but focused on upside surprises. But also, correct me if I'm wrong, John, I believe the 2/7 curve is pretty close to being flat, almost inverted.
Yeah, there are parts of the yield curve that analysts are watching with consternation, getting flatter and flatter. We saw, the main sort of yield curve that people talk about, the 2s, 10s, crashing down to its flattest in 15 months kind of level. This is, it's not that main part of the yield curve isn't inverted by any stretch of the imagination yet, but it's certainly headed in that direction or headed in a flattening direction, a pronounced flattening direction. The dollar, which corrected downward in early January, has gotten a boost from this Fed, and we think that this is in some sense, this communication strategy, this aggressive communication strategy, is a way for the Fed to front load its tightening without actually front loading its policy maneuvers, and gives it maybe some flexibility down the road. So we'll see. The labor market was very interesting. This has been one of the key aspects of the pivot of the Fed, talking about labor market dynamics. Where is full employment? What is this labor market, this pandemic or late pandemic labor market really all about? And the Fed has determined that it's really tight. This is a really tight labor market. It's a really hot labor market. But going over to John Dick, I know you do a lot of work on sentiment and thoughts on labor markets and job dynamics, and definitely want to hear what you're picking up. Well,
I mean, sentiment about the job market's still great. I mean, people know there are jobs if they want them, and workers have more leverage on salary demands, and this is the time of year when budgets are being done and people are seeing their raises come through. So that's all good. But back to the bifurcation thing we talked about earlier in the economy, that the sort of lower end of the income spectrum has a different outlook than the rest, right? But that's also where a lot of the departure from the workforce came from. Those are mostly younger workers who look, if you're in your mid 20s or so, and you're getting a couple fat stimulus checks, and you're squirreling some money away you didn't spend, and making some money on crypto, which is a non-trivial impact. A third of adults between 18 to 29 have investments in cryptocurrency, which is nuts. And you make an extra $5, $10, $15, $20,000, and you're in that age group. that's enough to step out of a job you don't like for a while, right? And we think that's a lot of what happened, but that's not like retirement money. That's not FU money. That's like, hey, I'm going to maybe, step out of this crappy job until after Christmas and maybe get back into the workforce. And, and I think we're going to see some of that happen. I don't necessarily have sentiment indicators to suggest that, but everything else kind of points to that, whatever that extra money that allowed people to step out of the workforce is going to slowly dwindle away, and you're going to see those people stepping back into those jobs. So we're kind of optimistic for the service sector that you'll see, some of that quote Great Resignation revert back to normalcy in the next quarter and a half.
And in our show, in our previous show, we had Lawrence Smith, the president of Skyline Policy Risk Group, talking about the supply chain aspects. And this is something that it was a major feature of the Fed's sort of transitory inflation thesis. It has obviously been sort of de-emphasized in the discussion about inflation now that they're fighting inflation. And the Fed doesn't necessarily have a good explanation as to why higher interest rates or shrinking the balance sheet will do anything to impact supply chain. Just interesting to note that the Liberty Street Economics, the blog from the New York Fed, has just put out another piece on supply chain and how much supply shock dynamics are feeding into the US CPI and PPI. It's almost like, you don't want to read too much into it, but it's definitely as though the message from the New York Fed staff is, hey, we're still here on the staff. We still see some of these very idiosyncratic dynamics really.
They do, but look, they've been wrong. Right. Look, I know that it's there and it's a part of it, and there's no questions. I don't have a good. I can't wait to read the blog. Right. I want to get their sense of what how much they think the inflation is, the composition of inflation is from that. But look, the Fed has consistently expected in successive quarters for inflation to taper, and it hasn't, and that's a policy failure, to call it what it is. Their job. It is their job. They only have two jobs, right? Full employment and price stability. They're nailing one of them, and they're failing on the other one. And whatever the reasons or rationalizations are, they have, and they got to get this right, because after a while, economies will fix themselves, as we say. The cure for inflation is high prices. You don't want to, meaning that prices will get high and people will stop buying stuff. And if people stop buying stuff, then people are going to start making, marketing, and distributing stuff. And that's called a recession, because then you don't need people to go do those things. So then you fail on the other mandate. So you want to do it in a way that is smooth and predictable and doesn't cause volatility. Right now, we're seeing, as you noted earlier, we could do a whole show on equity market volatility. It's been crazy, wild swings on any given day, 1,000-point swings in any direction, in both directions. So like, there's a lot there, and they do need to get it right. And I hope, keep studying, but sharpen your pencils, but get this thing right, because you got to get it under control.
Tony, I think you misspoke. I think they have three mandates. Well, ever since I've been following them, I think that keeping the S&P as high as it possibly can be is the third mandate, isn't it?
Technically, if you really read the charter documents and statute, they technically have four. They technically have four mandates, which include so financial stability is a mandate, and also keeping low average interest rates is a mandate, but all of those are a slave to price stability.
When we talk about supply shocks at this point, one of the things that obviously the supply chain has been an issue, but the energy supply shock is something that is much more acute in the EU and other places in the world. But we're obviously experiencing some of that, and what is happening in oil prices. Oil prices are a risk asset, right? They're very correlated with the stock market. They're very correlated. They're negatively correlated with the dollar. They're very correlated with market-based gauges of inflation expectations, break-evens, but not now. They're shooting higher. Break-evens are basically sideways at moderately elevated levels. The S&P 500 is down, almost 10% this year, and the dollar is at, its highest level since 2020, and oil prices just keep marching higher. And a lot of this is around Russia, Ukraine. We haven't seen a geopolitical risk premium baked into oil prices, a significant one, for a really long time. And just wanted to talk a little bit about that. I don't know if there are any ways in which this is showing up, geopolitical risk is showing up in your surveys, John, or if this is playing through. It's certainly to the global community, it's a very worrisome thing, but it doesn't necessarily always filter down to street level in the U.S.
You like supply chain, you mean?
No. Just like, if you watch national media right now or my Twitter feed, it's dominated by Russia, Ukraine. Biden, right? Do people care?
I mean, there's not a lot of evidence that people are focused on it. I mean, look, there's a bigger, huge macro trend, which has just been a significant erosion in news consumption among Americans across the board since last January. I mean, the level of fatigue between politics and just COVID. People are playing Wordle instead of that's the first thing they do when they wake up in the morning instead of checking the headlines. And so, I think you've got a certain sector of the, intellectual, educated, politically in tuned sector of the economy that are paying attention to it, but doesn't appear to be spooking anybody. There's certainly no evidence that it's affecting like the ESI, which is generally a pretty good pulse on that kind of thing. No, I mean, news consumption is way down. And incidentally, it's particularly down among Democrats, which would be a group who tend to be more worried about something like that on the global stage. So, yeah, I mean, it's, for better or for worse, people are kind of, I don't know if they're whistling through a graveyard or just sort of, again, distracted by other things, but there's very little evidence that it's having sort of a macro effect on the consumer.
It's really great, interesting to hear you. Not great. I wish everybody was reading the newspaper every morning, but interesting to that you sort of confirm that. It's kind of what my gut said, and what my sense was. It is going to be a very big deal if it happens, right? If Russian troops start rolling, tanks start rolling into Ukraine, and there's a hot war in Ukraine. It's going to impact a whole lot of things, and I think it's going to surprise a lot of people. And there will be John and Brenda, I'd love to get your thoughts on this in terms of the economic impact of it. There's obviously energy market volatility potential, but Russia is not a well integrated. Otherwise, energy is not an important economy in almost anything else besides energy. So what would the economic impact be?
Well, I mean, in energy, even that is very uncertain, right? How much can Russia really tighten the screws on its gas and oil sales, because they depend on those? Russian assets have not been doing well in the face of this aggression against the Ukraine. We've seen we've seen falling Russian equities. We've seen the ruble suffering. There's certainly talk about the U.S. imposing sanctions that might severely curtail the purchase of Russian sovereign bonds. Potentially, the U.S. isn't going to put troops on the ground. And so they're going to pull other levers. The Biden administration team knows a whole lot about economic and sanction, countermeasures when it comes to global aggression. And this is something that will have, potential ramifications that are wider. If the extent to which Vladimir Putin wants to use the gas as a weapon, that is something that we've seen a little bit of an inkling of that, but he could certainly get more aggressive on that front. The sanctions would probably spill over to some extent, and just the overall uncertainty about this situation, creating a bid for safe haven assets like the dollar and long-term treasuries, which gives a disinflationary, reflation in reverse kind of dynamic and signal that markets are very sensitized to at this point. So we think that this risk is very much part and parcel of the current volatility and some of the dynamics that we're seeing. We don't think you can dump it all at the feet of the Fed and say, look what you're doing to the yield curve, the dollar, and equities. This is a real big issue, and the risk of a stagflationary energy price shock that emanates from this is something that maybe markets aren't pricing in entirely, but are contemplating as a risk scenario.
But John, don't you think that Ukraine's nuclear stockpile will deter Russia? Oh, wait, I forgot. They gave that up with the promise that Russia would never invade them.
never make, or if you're going to make deals with Russia.
There must be some funny saying about
as the Gipper said,
a Russian and nuclear weapon.
Yeah, as the Gipper said, trust but verify. And I would say only verify. Don't trust. Yeah. Well, look, but look, I don't think they're going to. I don't expect to see them actually invade Ukraine. I'm not trying to be Pollyannish. I just think it's a losing bet for them near term and long term. And I don't think they, in terms of, can they sustain it? They've got, massive gas and oil reserves. They also have massive cash reserves also. They have done a good job over the past 10 to 15 years of building up reserves, so they can withstand some economic shock for some time, but I still don't expect to see them taking that route. I think Putin plays a very long game, and we're not in the eighth inning. I think we're probably closer to the fourth or fifth inning for him. But we'll see by this time next week, as people keep predicting it as though we're on the doorstep. We'll know a little bit more. Guys, thanks for a great show. John, Dick, great to have you with us as always. John and Brendan, have try to stay out of the weather this weekend with this bomb cyclone on its way, making its way up the East Coast. I will be inland to avoid it, but hopefully able to get out on my snowboard. Have a great weekend, guys.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.